My name is Michael Grandy. I'm a professor at Providence College teaching managerial accounting, and we're going to be talking about job order costing today. Specifically, we'll be going over a problem we did in class, job order costing with allocation of the manufacturing overhead difference, that is the underapplied or overapplied. We're first going to go through a whole bunch of journal entries that are associated with the cost buildup and cost flows through the inventory system. Then we're going to post those journal entries, or the relevant part of those journal entries, to the manufacturing overhead account and to the work in process account. We're then going to take a look at the manufacturing overhead account to determine if there was any underapplied or overapplied manufacturing overhead. And then the question is, how do we dispose of it? How to resolve it? Where do we put that difference? What type of an allocation? And specifically, what is the company's policy with regard to allocating that manufacturing overhead? So we're working with the handout that I distributed in class. And this is Shanley Manufacturing Company, makes a product to customers' specifications. For the current year, the company estimates that they will have $10,000 of manufacturing overhead expense and will have an estimated 500 direct labor hours. During the month of June, the company had the following transactions. So in the very first paragraph there, they're giving you information that you can use to calculate the predetermined overhead rate. And as you recall, that formula is total estimated manufacturing overhead dollars divided by the activity base. In this case, it is hours, specifically direct labor hours. So let's take a look at that predetermined overhead rate, which we're going to use later, and that's total estimated dollars in manufacturing overhead divided by total estimated activity base. In this example, it's going to be $10,000 divided by 500 hours, and that's going to be $20 per hour. $20 per hour. That is the predetermined overhead rate, which we'll use later on to allocate manufacturing overhead to our product cost to the work in process account. So we're going to come back to that later. Let's start looking at some of the journal entries. I obviously don't have enough room on this board to put all of the journal entries at one time. We're going to erase and we'll come back, but you can follow along. Transaction A, raw materials were purchased for $800. So journal entry A, we're going to have a debit to raw materials, RM, for $800. And I'm going to have a credit to accounts payable for $800. Journal entry B, they requisitioned $900 of materials from raw materials to start working on jobs. $700 for direct materials and $200 for indirect materials. And they make an allocation here between job A and job B. Got two jobs going on. And job A, they allocated $300 of materials and $400 for job B for a total of $700. But the journal entry, the journal entry is just going to be looking at the work in process, which is for the direct materials of $700. The manufacturing overhead is for indirect materials, and that is $200. And this is coming out of raw materials, which is $900. Later on, we'll look at the details for job A and job B as we keep track of things. We have journal entry C. Salaries and wages were calculated for the month as follows: $1,000 for direct labor, $300 for indirect labor. Of the $1,000 for direct labor, we're telling you that $400 was for job A and $600 was for job B. But the journal entry C, is going to be a debit to work in process, the $700, that is the direct labor. We're going to have a debit to manufacturing overhead. This will be for the indirect labor, which is $300. And we're going to have a credit to wage payable for $1,000. That could also be to cash as well. Not too concerned about that. Item D, utilities, insurance, property taxes, and rent expense for factory was paid during the month for a total of $190. Key word here is that this is for factory related costs. Because they're factory related costs, they're a cost of production, that's going to be a component of manufacturing overhead. So the journal entry for D is going to be a debit to manufacturing overhead for $190, and we're going to say accounts payable for $190 as well. Okay, that is item D. So that's transactions A, B, C, and D. We're going to erase this and we're going to take a look at some more transactions. This will be item E. It says actual direct labor hours for the month were 10 hours for job A and 20 hours for job B. Now what we're saying here is we have actual activity, and remember we're allocating manufacturing overhead on the basis of direct labor hours. So they just told you the total number of hours. They add job A and job B for 30 hours. And we need to remember the formula for manufacturing overhead applied equals the predetermined overhead rate multiplied times actual activity. At the very beginning of the problem, we calculated the predetermined overhead rate by taking total estimated manufacturing overhead dollars of $10,000, dividing it by the total estimated activity base, the denominator value, which was $500, and we came up with a predetermined overhead rate of $20 per hour. We want to look at the problem, item E. It says actual direct labor hours per month were 10 hours for job A, 20 hours for job B, for a total of 30 hours. Manufacturing overhead applied is going to be $600. And remember what we're doing there. We're transferring money out of the manufacturing overhead account into the work in process / product cost account. And that journal entry is going to be a debit to work in process for $600 and a credit to manufacturing overhead for $600. Again, that is journal entry E. Now we're looking at journal entry F, and it says both jobs are completed. So at this point in time, we want to take a look at, we want to do some posting of journal entries to both our work in process account and our manufacturing overhead account. But we also want to take a look at the costs that we've accumulated so far for job A and job B. So we're going to put those over here. We're going to take a look at the work in process account. And we're going to take a look at the manufacturing overhead account. We're going to post some of those transactions that we had. And for work in process, we had direct materials of $700. We had direct labor, $1,000. And we just had manufacturing overhead for $600. So we have a total in that account of $2,300. And what we need to remember, that is for both job A and job B. Let's take a look at manufacturing overhead to this point. We've got $200 that we posted for indirect materials. We have $300 that we posted for indirect labor. We had $190, which was for these other factory related costs. And here's our $600 that was manufacturing overhead applied. Let's take a look at job A and job B. Job A and job B. Again, remember we have three components: direct materials, direct labor, and manufacturing overhead. And let's put a total over here, because job A plus job B equals our total costs that we're tracking. And where do we get the detail? Well, we have to go back into the problem, into the transactions, and look at what they said. So if we look back at transaction B, it said that $900 of materials were requisitioned, $700 for direct, $200 for indirect. But I'm telling you in the parentheses that $300 was allocated for job A and $400 for job B. So we're going to put $300 here, $400 here, and guess what? That's $700, isn't it? Which happens to exactly equal the $700 into work in process. Let's look at direct labor. Again, that is in transaction C. We said there was $1,000 of direct labor, and in parentheses I said $400 was job A and $600 for job B. So we've got $400, $600 for $1,000, and that was the debit into the work in process account for direct labor. Let's look at manufacturing overhead. Manufacturing overhead, we're looking at item E here. Actual direct labor hours for the month were 10 hours for job A and 20 hours for job B. Now remember, this is where we calculated the manufacturing overhead applied for. The total was $20 per hour times 30 hours for a total of $600. We're going to break that down between job A and job B. It said job A had 10 hours. 10 hours times $20 is going to be $200 of manufacturing overhead. Job B, we said there were 20 hours. 20 hours times $20 per hour is going to be $400 for a total of $600, which is what we posted to the work in process account. So job A and job B, we have the breakdown. We have $900 in job A. We have $1,400 into job B. Add the two together, $2,300. Again, that is not by coincidence. Job A and job B, the total of the jobs is supposed to equal what we have in work in process. Remember, we're working on item F. And item F says both jobs are completed. So now we need to transfer this money from the work in process account to finished goods because it's completed. So item F, I'm going to put that up here. We're going to write that in black. Item F, we're going to have a debit to finished goods for $2,300 and a credit to work in process for $2,300. Remember what we said, both jobs were completed. Let's look at item G. It says job A is sold to a customer for a total price of $1,200. Job A, only job A. So what we need to do here is we need to do two things. We need to record the sale of the product, sale of job A, and we also need to transfer the cost from finished goods into cost of goods sold. So let's record item G for the sale. And we first have the sale transaction, accounts receivable. We sold it for $1,200. We're going to have sales revenue for $1,200. We also need to recognize the cost of the sale. Remember the matching principle. We record the expense of the product at the time that we record the sale. So here we're going to debit cost of goods sold, and we're going to credit finished goods. But we know, so what is the cost? Well, job A is $900. We kept track of job A. We know that job A was $900, so the debit to cost of goods sold is $900, taking it out of finished goods. We've recorded the sale and the cost of goods sold. It's item G. Now, item H. It says resolve the manufacturing overhead account, assuming the company's policy is to allocate the over-applied or under-applied manufacturing overhead in the same proportion that manufacturing overhead was previously applied. That's the company's policy. First, let's look at whether we have an under-applied or over-applied. Again, we're looking at the manufacturing overhead account, and let's remember that the debits here represent actual costs. The credits here represent applied to work in process. We have $690 of debits, $600 of credits. We have $90 net debit. Well, what does that represent? Well, let's think about it. The actual costs was $690. They only transferred $600 into the work in process account. They did not put enough cost into their product cost account. They have leftover cost. They under-applied. Under-applied manufacturing overhead. As we talked about in class, we need to resolve this account. We need to periodically, ideally on a monthly basis, zero this account out. Make sure that our product is fully costed so that the total cost of making our product gets into our product cost account. But we have two products. We have job A, we have two jobs going on, job A and job B. The question is, how do we allocate this $90? Well, let's remember what we said. The policy is to allocate over-applied or under-applied manufacturing overhead in the same proportion that it was previously allocated. So we're looking at manufacturing overhead. How was it previously allocated? We had $600 of total manufacturing overhead that was applied. 200 of it went to job A, 400 of it went to job B. 200 of 600 went to job A. That's 1/3, right? 200 divided by 600. We had 400 of 600 that went to job B. 4 divided by 6 is 2/3. Obviously, the $600 is 3/3, right? So 1/3 of the manufacturing overhead was previously applied to job A, and $400 was previously applied to job B. And a 1/3, 2/3 ratio. So when we clean this up, we're going to allocate that $90 in that same proportion. So let's think about it. We've got $90 here to allocate. Well, this is the under-applied, right? We know we've got a total of $90 that needs to be allocated. Well, how much is going to be allocated to job A? Well, 1/3, right? 1/3, which is going to be $30, is going to be allocated to job A, and 2/3, 2/3 times 90, is going to be $60, is going to be allocated to job B. 1/3 of 90 is $30. 2/3 of 90 is $60. So $30 is allocated, 30 of the 90 to job A, and 60 of the 90 goes to job B. Well, we know how much is going to each one of these, but the question remains, what is the journal entry? What is the journal entry to clean this up? So this is going to be journal entry H. And we need to be careful. We need to ask ourselves, where is the cost of this job right now? Where is job A and where is job B? Well, job A, again, we'll look back at item G. It says job A was sold to a customer, right? And journal entry G, we recorded the sale. So job A was what? Sold. The cost ended up where? In the cost of goods sold. CGS, cost of goods sold. What about job B? Again, let's look back. Item F, it says both jobs are completed. So the cost of job B is, they have not sold job B. The cost is where? In finished goods. Hasn't been sold yet. It's completed, but unsold. So asking yourself, where is this job, will give you the answer to what the debit is for this transaction. Well, we clearly need, in order to zero out manufacturing overhead, we're going to need to have a $90 credit. So we can get that in there. That's pretty easy. Manufacturing overhead. Going to credit that for $90. But we need some debits. Well, job A. Where's job A? Job A is in the cost of goods sold. I'm going to debit cost of goods sold for $30. That's to be allocated to job A. Job B, as we said, is in finished goods. Finished goods for $60. So we have resolved, cleaned up, zeroed out the manufacturing overhead account. We closed it and we've allocated it in accordance with the company's policy that says the company's policy is to allocate the overapplied or underapplied manufacturing overhead in the same proportion that manufacturing overhead was previously applied. Previously applied 1/3 to job A, 2/3 to job B. We've got $90 of underapplied. 1/3 of 90 is 30. That goes to job A. 2/3 of 90 is 60. Goes to job B. The last item that we have here on this worksheet is item I. It says prepare an income statement through gross margin before and after the journal entry for H. So what is a income statement through gross margin? Well, it's simply sales minus cost of goods sold equals gross margin, right? So we have before, and we're going to have after. Sales. Well, where are these numbers coming from? Well, it's basically going to be journal entries G and H. Sales revenue. Sales of $1,200. Cost of goods sold before journal entry H is what? $900 right here. Gross margin, $300. What's my gross profit percentage? GP percentage. 300, what? 300 divided by 1,200 equals 25%, right? That's my gross margin. Let's take a look at after the sale. After journal entry H, the sales revenue doesn't change. Sales revenue is going to stay at $1,200. But look what happens to the cost of goods sold. Journal entry H does what? Adds $30 to the cost of goods sold. 900 plus 30. Cost of goods sold jumps to $930. My gross margin drops to $270. And my gross profit percentage also drops to what? 22.5%. That's what? $270 divided by $1,200. It's important that we know that because, again, we need to know this on a timely basis so that on a go-forward basis, the company may want to change its sales price so that it can maintain its 25% gross margin. Gross margin dropped. So those are all the journal entries that are associated with job order costing. We posted to the two important T accounts, work in process, manufacturing overhead. More specifically, kept track of job A and job B. And then we did what? We resolved the manufacturing overhead account. In this case, we had underapplied and we allocated it to the two jobs in the same proportion in which it was previously applied. So I hope that helps. Thank you very much.